Real estate syndication is really not owning real estate. It's a 5-year business deal.
Yeah.
And either the business succeeds or it doesn't, but you're against the clock. Leverage is really good when it works well, but if you're leveraged at 80% loan to value, at 20% downturn, your investment's gone.
And what the individual said was, I didn't know real estate investment can go to zero.
If you don't know how something works, ask a question.
The views expressed in this podcast are those of the individual guests and do not reflect the opinions or recommendations of Invest Clearly. This podcast is for informational purposes only and should not be considered investment advice. The appearance of a sponsor or investor on this show does not constitute an endorsement or a warning. Invest Clearly is an objective and neutral platform. Always do your own due diligence before making any investment decisions. Awesome. Ron, thank you very much for joining. I know you and I have been communicating on LinkedIn a little bit. You've been an advocate publicly, so I really appreciate that. Why don't we just start by tell us a little bit about your background? I know you're in the hospitality business, but would love to learn a little bit more about what you do, and we could jump into it.
Sounds great. Thanks, Pat. It's a pleasure to be here. I got started in investing when I was a teenager. And so I'm in my mid-60s now, just turned 66 this past week. And so I've been doing this for a little bit of time. I started on the financial side, trading bonds, and then that led to trading futures and options and hedging portfolios. And so I even wrote a white paper at one point that I sent to the Chicago Board of Trade because I thought one of their indexes was priced wrong. They didn't give me any credit, but a few months later, after sending the paper, and they changed the way the index was calculated. So
awesome.
I don't take any credit for that, but it was really interesting is that I had been asked, because I had submitted the paper, somebody had heard about it, I'd been asked to speak at a business conference, and I was a nobody, worked at a boutique, firm, no research background, no publications on the Wall Street Journal or anything like that. And I gave my presentation right after lunch. So, nobody was there or very few were there, and people were probably still sipping on their martinis or whatever. And,
yeah.
And so the keynote speaker was asked a couple hours later in the evening session whether they had been at my presentation. And he said yes. And he was a high-powered research analyst, right? And he said, yeah, there's not much to it. So the very next day, somebody came up to me that had been at the presentation. He said, did you read the bond buyer index today? And I go, no, why? He goes, because the Chicago Board of Trade just announced that they're changing the price of the index because it had been calculated incorrectly. So, again, nobody knew who I was going in or after I came out, but it was kind of one of those.
Tell the story, take credit. Yeah, that's your story. That's awesome.
So I spent about 2 decades trading bonds and futures and options, and then got the midlife itch, and I went and taught religion for another 2 decades, and then my father-in-law passed away, and so I started running the family business. We have 3 motels, 2 in Florence, Oregon, and 1 in Salina, Utah. So out in the middle of nowhere in all those locations, but that has given me kind of the start into real estate. I'd never been much of a real estate investor prior to that time or paid much attention. We had a home that we couldn't sell once when we wanted to, so we rented it out for a little bit, and that was the extent of my real estate investing. But I had read probably thousands upon thousands of, red herrings or prospectuses in the bond industry. Had, sued some people because they weren't following the guidelines that they had put in that, and had, our firm had won. And so it was one of those things. I had a great background, but really no experience until a couple of years ago.
Sure.
And so at that time, 100% of my portfolio was in equities or cash. And I decided, well, it's time to look at maybe diversification a little bit as I get into retirement age. And so the idea was to put some passive income in my portfolio, something that I didn't have to manage. I mean, I thought about going out and buying my own properties and managing them, because that's what I do every single day in the hotel business, right? They're the shortest of short-term rentals, as I like to say.
Yeah.
That's all they are, is that they got rooms that need to be sold every night. You got people that got to clean them and stuff like that. And so anyway, that's a little bit about me. So why don't you take it from here and let me know what you need to know.
Sure. No, your story is pretty interesting. One of the things I love about engaging with you on social media is, like, you're pretty outspoken about risk versus reward in the passive investing space. It's not, I feel like LinkedIn sometimes can turn into this grovel fest of everyone kissing each other's hands, but you're like a realist on there. But what's interesting is your background of risk assessment. You were a full-time trader, and then you're challenging the potential narrative of risk in the passive investment world. How do you think about that? Like, how do you think about risk today and I guess what people are actually saying?
So here's the thing. When I took over, my father-in-law passed away. When I took over the business, I went to my mother-in-law and I said, hey, look, we can sell everything. I can go invest it, give you the same type of income that you're getting now. I'll be in a world that I know, and I won't take on market risk. I won't take on interest rate risk. I won't take on any of that other stuff that people sometimes forget about. And I think as I've learned more about the real estate syndication, I see that piece missing a lot, is that leverage is really, really good when it works well, and it's terrible when it doesn't work well, right? I mean, because a 20% downturn wipes you out. Probably less than that because of expenses and things like that. So, but if you're leveraged, at 80% loan to value, at 20% downturn, your investment's gone.
Yeah.
The bank gets paid before you do and stuff like that. And the other thing is that, there's a big time risk in real estate syndication. I mean, and that's what I'm going to refer to when we talk about passive investing here, because I have a lot of dividend stocks, and that's really passive. As a matter of fact, a lot more passive than real estate investing, and maybe just because I know it better. But so there's time risk, there's market risk, there's interest rate risk, there's liquidity risk. I think one of the things that I see is, people sometimes talk about return in the decimal place, and oh yeah, you're going to get 15.5% return, and I'm going, how the hell do you know what's going to happen in the next 5 years, right? Yeah. It's just so unpredictable, and I don't think all of that's priced in. And I think returns are probably a little bit low for the amount of risk that you're actually taking on. And there will be people that have been doing this and not agree with me one iota.
Yeah.
But until the occupancy drops 10%, or until the cap rate goes from a 4.5 entry to a 6.5 exit. All right. So, I mean, I did some calculations, because I refinanced the hotels in 2019, and I think it was in the low fours. And so, I'm going, okay, I've got a 10-year balloon on this thing. So I've still got a few years, but I started calculating, okay, what interest rates is my pain point to go into. And right now I'm really fine because I've paid down enough principal, but some of these things are just not calculated correctly in terms of, okay, here's your return, and this is so much better than anything else you can do. And I'm not afraid to call out BS when I see it.
Yeah, no, I love it. And you've got people shouting from the rooftops, comparing it to the public markets and how many different advantages you have in it. And then I've got LPs in my inbox saying, hey, I'm done with this. I just got wiped out when I was told this was the best buying time in history. And I'm staying in the public market. And so I'm with you. One of the things that you had said to me once, Ron, as we continue to go down to risk, you had talked about writing reviews, but what you had said to me was, hey, I want to wait a couple months because I want to make the determination if it's a bad operator or if it's market conditions. How do you tell the difference? And I think that's people are challenged with right now is like contextualized track record. How are you making that determination?
So I didn't get into the markets when I wanted to. I mean, I started looking at syndication probably late 2020 after COVID. I had some money set aside. I wanted to put that to use. It had come basically from the sale of a house. And so I didn't want to go back into anything but real estate. And so I started looking at options, but the Fed started to raise interest rates. And I can remember talking to a couple people really early on, they were 0.25%, 0.5%, 0.75%. And I go, okay, we're about done when they got to about a 1.5%, 2%. I said, no, I think this thing could go as high as 5.5%. Well, I pretty much nailed it right on. And so when we got there and it stabilized, I go, okay, now I feel fairly comfortable. We're at a more normalized Fed funds rate. And so I didn't see as much risk there, but inflation still was pretty high. And we were noticing in the hotel business that, the cost of getting any work done and supply chains and stuff like that still weren't back online completely. And so I waited until 2023 when I felt that we had reached the point that the Fed could hold. I thought they were going to actually hold a lot longer than they did at where they were at. I know that their two main focuses are inflation and jobs, right? And they've come back in and started to lower because of jobs mainly, because I don't think inflation's completely under control, at least not to the extent that they believe it is. And I'm going, okay, they'll lower, but I don't think the job situation is like it has been in the past. I think, I think a lot of the jobs being lost are due to AI and not because businesses are doing terrible. And so I think we're going to have to work through that one and figure that one out. But anyway, so they started lowering interest rates and everybody said, well, as soon as the Fed starts to cut rates, we're going to start recovering. And we haven't. As a matter of fact, prices continue to drop, or people claim that they're buying better deals and stuff like that. And, on the yield curve widened out a little bit. And now we're talking my turf, yield curves and stuff like that. And it widened out, keeping mortgage rates, pretty flat. I mean, going nowhere for quite a bit. They just started to come down again. And so I look at that and I go, okay, I've taken a chance, and I'm going, an operator really shouldn't be held responsible for that. Right? It's not their fault that the market acts the way that it does. Right? And so, so I bear the risk of market calls, right? I bear the risk of changes in, interest rate environments. All that is part of the investment world. Sure. Right? And so if an operator can still bring a really good deal and it not make a whole lot of money. And that's not necessarily their fault. Right. So to ding an operator because they did a really good job and the market just went against them. Being a trader, I was never a bad trader because I lost money on a trade. Sometimes things just didn't work out. And so I want to be really cautious in how I evaluate people, because I had a 5-year investment is what I told myself. And my longest one is only 2 years into it, 2.5 years into it. So it's only halfway. And there's still a possibility that it may do everything that the operator said it would do by the time we get to the end. It just won't be as smooth of a path as I thought it was going to be. Does that make sense?
Totally. And I always tell people, like, there's accountability on both sides, right? Like, it's not 100% the operator's fault all the time. Obviously, there's a level of risk underwriting they should do, but things happen. Yeah. Like, good operators, bad deals happen, right? And it's important what I call, again, contextualized track record, right? Yeah. Is it the market? Is it the operator? And you've really got to understand how to do that due diligence. So I imagine... So
you want to know the bad operator?
Huh? I want to know everything.
Okay. So you said, okay, why do I... why am I a little bit reticent of just evaluating right out of the chute, just because, it's not performing well? Well, there's still people that I think that that are good operators, and, the deal just hasn't gone as smoothly as they want. I'll be a little bit patient. But then there are people that I have in a couple of my deals experienced, and I've heard from other people some of their experiences, but I had one deal that I'm in, and it's basically comatose. I mean, the only thing that hasn't happened yet is the ink hasn't dried on the death certificate, right? I mean, yeah. But I've in my mind, I've completely written it off. It's just a capital loss, okay? And so, but there were some things on that deal that I thought were maybe should have been done better. First of all, you're shown a pitch deck, right? And it says, hey, we're going to get so much capital. Right, this is how much capital we're going to raise, and this is how much equity we're going to raise. Well, they had one of their, somebody backed out, and instead of coming back to the rest of the investors and saying, "Hey, look, we're undercapitalized. What do you want to do?" They just moved forward, and so the deal started underwater. All right, it started in a bad position, and had I been given the option, I probably would have backed out, because, right, I'm going, okay, this is what you said was going to happen, and here's where you're at, and they don't line up. And on that same deal, All right. I expect I have some responsibility, but when an operator says that they'll take care of the due diligence, I expect them to take care of the due diligence, right? And so I expect them to double check and make sure that the rent rolls are correct. Make sure that the occupancy is exactly where they say it is. Make sure that they've inspected the building and they've outlined all of the repairs prior to closing on the deal. Right? And so when the occupancy is 10% lower than what you thought going in, coming out of the chutes, or when there's 100,000 or more in repairs that weren't identified until after you closed, I kind of put that on the operator. I mean, that's kind of the passive approach here that I'm expecting, is that, hey, look, when I look at deals all the time for our own personal real estate and money, and right, I mean, I have turned down some deals because take somebody out to the property and they say, okay, here's all the repairs that are going to be needed. And I go, probably not for me.
Yeah.
And I mean, I'm not afraid. I've taken 2 projects down to the studs and redone them. Right? So that's not a problem, but it's like, if the work is going to be more extensive and there's not a price break to compensate for that. I'm looking at a deal right now that's a laundromat, and the equipment's 16 years old and held together by duct tape and baling wire, right? And, and the reviews are terrible on the place. And I'm going, okay, I'll have to take that into consideration. But I know going in, right, long before I ever close, as to what's at risk. And that's, if an operator doesn't know that, and it's reasonable that they should, they should be held responsible for that.
For sure. And when did you find all of this out? Like, when did you find out they were undercapitalized going in? When did you find out the occupancy was right? Was that like first communication out to investors, or did this get uncovered later on?
It was maybe the second.
Sure.
And maybe I might have missed it, but I got a distribution, and then I was told after the distribution, oh, by the way, and I'm going, wait, how come my distribution is higher? And actually, I probably didn't realize it until the K1s came.
Yeah.
And I go, how come my percentage on this deal is much higher than I anticipated? And oh yeah, we sent something out that said that we decided to go forward with this, even though we weren't fully capitalized. And so let's just say maybe I should have known about it earlier, but I didn't know about it until 6 to 9 months later.
Sure. Yeah. This episode of the Invest Clearly podcast is brought to you by Scale IR. If you're raising capital, you know the hardest part isn't just generating leads, it's turning those leads into committed investors. That's where Scale IR comes in. Scale IR transforms your investor engagement process with their proven solutions that optimize lead qualification, accelerate investor conversations, and drive higher conversions. From seamless CRM integration and intelligent workflows to expert investor qualification specialists who handle your initial discovery calls, Scale IR gives your team freedom to focus on closing deals. If you're ready to scale your investor relations and capital raising effectiveness, visit scaleir.com to learn more and book your strategy call today. Scale IR. Engage smarter, convert faster. Do you think in your evaluation, if you think of a newer investor that's listening to this episode, to avoid something like that, is there anything you could have done, or was this just what happened and I couldn't have avoided it? You know what I mean? It's tough to play hindsight, but do you think, is there advice that you would give someone maybe in your position looking at this for the first time? What could you have done to see this potential?
Looking at things at the first time, I wish I knew then what I know now about the industry, because the early deals I would have asked a lot more questions. Right. And I'm not the type of guy that says, oh, what do you need? Let me send my check. I read the PPM on all my deals.
Yeah. Okay? I imagine you're a force to be on the other side of the phone call, especially with your background. So that's, yeah.
So, I mean, I have enough investment experience that I'm kind of outside the box compared to the normal first timer. I think, and I know we got a question later on about, what do I think we should do differently in the industry? So I'll wait for some of this until then. But I would say ask questions. If you don't know how something works, ask a question. Don't sit on a pitch, or on a conference call or send your money if you're still not sure how everything works. All right. And so I think that would be the first thing. I guess I was a little bit naive because when I was in the bond business and when I was on the trading floor, I mean, I transacted business, especially in the bond business by phone, without ever meeting people. And so I got a real good feel. And your reputation kind of gets around really quickly if you screw a lot of people. But you kind of had some laws in place that made it more difficult for people to treat people poorly. You had some mediation and arbitrage or arbitration, that you could go through if something bad happened. But in 20 years of trading, I think I might have had one trade where there was a disagreement, and we had to split the difference, the cost, because we didn't agree on something. This was even before phone calls were recorded and stuff like that. So I was just used to people being knowledgeable and honest in what they did.
Yeah.
All right. But I was also dealing with a bunch of people that they passed the Series 7 like I did. They had gone through training. They knew what their responsibilities were to transact in the financial world. And unregistered securities, we don't get that same type of atmosphere.
Sure.
Or unregulated. So, I mean, anyway, so the newbie ask a lot of questions. I would make sure that how the waterfall and the payout structures are going to work. All right. I used to think that some commodities like gold or even buying a piece of real estate had a pretty high transaction cost until I looked at some of the fees that are charged in a syndicate, acquisition fees and disposal fees and property management fees and asset under management fees. I go, man, okay, I should know how all this stuff works, right? So, okay.
Yeah. If you want to jump into it, you brought it up. I'll ask you, what part of passive investing do you think needs to die?
Well, in large part, all right, I wish the attitude of stocks versus real estate syndication would go away.
Yeah.
Right. I can show people how to make cash flow on stocks or using options that exceeds the 18 to 20% that they're going to get in a real estate deal. It doesn't have necessarily the tax advantages and stuff like that. I think the other thing that I think that should go away in passive investing is that there are a lot of benefits to owning real estate. All right. And like if you own a piece of real estate for 30 years and rent it out, you're going to depreciate that over the lifetime, right? Real estate syndication is really not owning real estate. It's a 5-year business deal.
Yeah.
And either the business succeeds or it doesn't. You're against the clock. And so I wish that people would stop putting some of the values that come from owning real estate in general or on your own that are not included in real estate that's transacted through a syndicate. Right? There are differences there. And I wish that distinction would be made clear, is that, okay, let's not talk about real estate in general. Let's be real specific about what we're talking about. If we're talking about syndicate, let's name the pros and cons of being in a real estate syndicate and not the pros and cons of owning a single family home that you're going to manage and stuff like that. And the other thing that I wish would go away is that let's stop saying multifamily is better than single family rentals. All right. I know some people that have done really well in single family rentals, a lot better than what I've been able to do in my multifamily portfolio so far. My mom is a case in point. She's owned single family rentals for 45 plus years, right? And she couldn't tell you the difference between an entry cap and an IRR, right? And yet the income that she's derived from her rentals has been sufficient for her to travel all over the world, all right, to have tons of stories, to enjoy her life. And she didn't need to do that through the multifamily. And so let's educate people. Hey, what are the options here? What's going to suit your needs best? They're there is no one size fits all here in this investment world. You can do it through options, you can do it through syndications, you can do it through single families. Let's be more educating on hey, look, what are your needs? What are the investment vehicles that you can use to achieve that? The other thing is, one of the things that I see is tax advantage. Hey, look, I reduced my W-2 taxes. Great. I have about 45 years of tax loss carry forwards that unless some of my real estate sells in the syndicates and I either have to reinvest or I want to take some out, I'll probably die before I can get
You're
through
good.
all of it. Yeah, because I'm not a real estate professional. I get a maximum of $3,000 a year in that write-off. And so let's not assume that everybody's in the same position. And there's one of the things is that probably everybody that's selling you a piece of a syndicate is a real estate professional, right? And so them being in a deal probably has they're going to get their money back a lot sooner than you will get it back because they get it back through tax savings. They pay a lot less taxes than you will. And that's fine. It should, but I just wish that was made clear. Let's make sure that, hey, look, we're talking about the average real estate syndicate LP is not a real estate professional.
Yeah.
Sure, there are some that invest as LPs as well as run their own deals, but let's just make sure that we're clear about what we advertise in our deals. I guess those would be some of the major things. What do you see that a lot of people say, hey, I wish I knew this better when I started?
Yeah. I'll tell you one thing, that what you had said in terms of what needs to die is, I wildly agree with it, especially on the stock market versus real estate investing narrative. It's a comparison you see often in marketing material, but I don't think it always reflects the personal position of the individual investor, mainly because I hear from LPs all the time that got smoked in the syndication and they'll only stick with active investing or the stock market moving forward. But a lot of the things that people wish they need to know, you brought it up quite a bit, is unfortunately a lot of people don't understand where they lie in the capital stack. I think you brought it up in two different places, is comparing owning real estate versus real estate investing. Someone had reached out to me and told me they were going to take $100,000 loss because it just wiped out the common equity. And what the individual said was, I didn't know a real estate investment can go to zero. I thought it always had value. And I was like, and the way to think about it is like, you're not owning a single family or a multifamily property where, yes, it would have to go to zero. You are in the top part of who loses first when it gets dropped. And that is what, people wish they know, is like, it was a lot more education and a lot less influence. That's where I see people getting hurt quite a bit lately. But no, Ron, honestly, great answers. Really enjoyed this conversation. I knew I would. We're at time, and I typically to ask people, hey, if they want to get in touch with you, where could they find you? But I would recommend all of the listeners to connect with you on LinkedIn, because I love seeing your comments all over the place, if that's what you're okay with.
LinkedIn would be best. I can't even tell you what my handle is.
Yeah. Search for Ron Moore. You'll find him commenting everywhere. That's fantastic. But Ron, thank you so much, and thanks for your support, and thanks for connecting with me. And this was great.
Thanks, Pat. It's been a pleasure. Have a good one.
Sure thing. Thanks for listening to the Invest Clearly podcast. To find verified investor reviews or to claim your GP profile, please visit investclearly.com. If you enjoyed this episode, please remember to like, subscribe, and leave a review, because that's how other people find the show. Till next time, invest clearly.